On Friday, 10th of March 2023, the US federal agency shut down the Silicon Valley Bank and put the Federal Deposit Insurance Corporation in charge of the bank deposits. But what happened all of a sudden that led to the possible collapse of the 40-year-old bank? And as many are saying, is it going to be the second Lehman crisis after 2008? Let's find out. Hello guys, I am your host Siddhant. This is Junior Talk. This is where we talk all that is happening in the world of economy, finance and business. Welcome to the show. Before getting started, let's have some background on Silicon Valley Bank. So, SVB was started back in 1983 by two gentlemen named Bill Biggerstaff and Robert Medeiros. The bank from the very beginning was positioned very differently. Unlike most of the other banks who address both retail consumers as well as corporation, Silicon Valley solely focused, as the name suggests, on startups and their financing. The bank from the very beginning focused on clients which are startups financed by venture capitals. It was a very niche market for a bank but a growing one. Eventually by 2023, SVB was the 16th largest bank in the US. Till 2018, the bank had a total of $49 billion in deposits, but that doubled to $102 billion by 2020, and by last year it grew even further to $189 billion. The main reason for this meteoric rise was VC funding. As pandemic hit the entire world in 2020, most of the people in the US started depending on the startups to get their thing done, like DoorDash, Stitch Fix and many more. This led to a sky high valuation for the startups as well as fundings from VCs. Before going forward and finding out the reasons, let's understand a little about how the deposit and reserve ratios in banking works. So, whenever a person deposits any cash in any bank, a certain percentage of that is required to be kept as cash, which is known as cash reserve ratio. In US, that is 10%. That means for every $100 of deposit, $10 must be kept in cash for liquidity purpose. Rest the bank can invest and do whatever to earn extra. In India, we have two reserve ratios. One is cash reserve ratio, which is 4%, and then for certain liquidity requirement, the bank must keep 18% in the form of SLR, which is statutory liquidity ratio, that can be in cash or liquid asset. So in total in India, we have 22% of reserve ratio for all nationalized banks. So what SVB did after the legal reserve requirement is it invested the rest of the deposits in HTM, or known as held till maturity bonds, that are generally long-term risk-free government bonds. Because at the time back in 2021, the interest rate was 0% and the bond yield was 1.5%, which means the bank was earning more than it needed to give to its depositors. But something changed during this period. In 2022, the Federal Reserve started to raise interest rate in the US as many of the central banks across the world did to control inflation. This led to a cascading effect and financing became very costly for businesses. So what startups and small business did, they started to begin withdrawing their money as fresh funding became very difficult. What this meant for SBP that people started to asking for their money which it had already invested in long-term maturity bonds. During this period, also because of the interest rate hike in the US, which went from 0.25 to 4.25%, the bond yield at 1.75 started to become negative for SBB because short duration bonds like 3-year yield become 4.71%. And as the VC funding started to dry up, startups began withdrawing their money as well. Result of which SVP had to sell its 21 billion of bond portfolio for a loss of 2 billion, which was reflected in regulatory filings. This led to the worst thing a bank can imagine, a run for bank. That means everybody started to withdraw their money, which busted the bank. If we'll go by the numbers in US right now, there is 3 trillion of cash reserve for almost 18 trillion of deposits. And out of that 3 trillion, only $100 billion is in pure cash. Rest are all in liquid assets. One other reason from the regulatory perspective was that when Donald Trump was the president, he made some relaxation for local banks like Silicon Valley Bank in terms of reserve filing and stress test. This led to the banks being relaxed in terms of stringent regulatory filing, which the national banks like JP Morgan, Wells Fargo, or Bank of America are subjected to do on a regular basis. All this led to a perfect blend of unwarranted risk management and liquidity crisis for SPB, rendering it unable to pay up deposits and approve loan for startups and small businesses. Since the break of the news, SVP has lost almost 63% of its share value. Because of the negative sentiment and lack of trust, many other related local banks have also lost significant amount of their share value, like Western Alliance, First Republic Bank, Customer Bancorp, etc. In the after effect of the crisis, the Treasury Secretary of US, Janet Yellen, declared that no federal bailout will be there for Silicon Valley Bank, and US federal agency only insures up to $250,000 in deposit. But because the main clientele of Silicon Valley Bank were startups and small businesses, most of the deposits were more than that. After that, on 12th of March, the Federal Deposit Insurance Corporation (FDIC) established a bridge bank. A bridge bank is like a mediator bank where the authority is transferred to the federal government. They announced that every depositor, irrespective of their deposit amount, can withdraw in entirety. This was a big relief for all the depositors at Silicon Valley Bank. But the ripple effect of the fallout has not just been limited to US. Because most of the prominent VCs like Sequoia, Lightspeed, Tiger Global, etc. are based out of San Francisco, many global startups which are funded by these VCs have exposure to Silicon Valley Bank. Y Combinator, which is one of the biggest startup incubator in the world, said almost 1,000 startups alone from Y Combinator will be affected because of this fallout. In India as well, leading names like Paytm, InMobi were set to get affected because of this fallout. Nazara Technology, which is one of the leading gaming startups in India, backed by late Rakesh Jhunjhunwala, had an exposure to Silicon Valley Bank through one of its subsidiaries. But later it confirmed that it has been able to clear all the funds from the bank. In the wake of these recent events, many people started to draw a comparison between the 2008 Lehman crisis and Silicon Valley Bank. But to be honest, there are some systematic and fundamental differences between these two events. Let's break down one by one. The first difference is the asset class. So, asset class refers to the type of asset. In 2008, many of the mortgages were in subprime loans, which were again backed by mortgages without any substantial asset with a leverage at 5 to 6 times. That means for every $23 of deposit, the bank had only $1 of cash. But in case of Silicon Valley Bank, most of the investments are in risk-free government bond. The second difference is, unlike 2008, the federal government was pretty proactive in taking matters into their hands before it created a far worse domino effect. The US Congress did a midnight meeting to decide a going forward strategy for the depositor, making them feel confident and safe about their deposits. And lastly, Silicon Valley Bank has an asset base of $210 billion for the deposit of $190 billion. Though some assets may be inflated, but there is a buffer in case of the bank goes into liquidation. But apart from all that, there is systematic risk in banking as of now. Risk management went wrong, investment decisions were made with short-sightedness, there was not enough provision for interest rate hike. All this came together and made the perfect storm for the collapse of Silicon Valley Bank. Looking at it now, this is the final nail in the coffin of the bank. It does seem that the banking and financial sector is in a hot mess in US as well as the worldwide because of the post-COVID symptoms. It will be nail biting to see how this turn out in the near future. So that's all for this episode, guys. I hope you liked it. I put a lot of effort and work into making this episode. That's why it will mean the world if you guys can like, share, and follow it on Spotify. Thank you so much for listening. Until next time.